Hello, my name is Darius Johnson. I am the fund manager for a newly funded hedge fund. I have used my investment and portfolio management expertise to invest in the current 10 stock portfolio. Now, the 10 stocks that I have chosen to invest in are all, or not all, but mostly from the consumer cyclical area. I have chose this area because I have read many investment books and articles by Warren Buffett, one of the most successful investors alive, and he is said to invest in what you know, which is what I've done. Now, this portfolio serves for two purposes, really. The first objective is to provide the investors with a decent dividend yield for the risk involved, because we are leaning our portfolio mostly towards value stocks while we do have some growth stocks involved in it. And the second objective is to create long-term wealth over the span of about 10 years. So the weekly returns for this portfolio are as follows. Because I got a late start, I only have from June 5th through the 16th, but within that time frame there was a return of negative 4.77. Meanwhile, the overall return through yesterday was negative 0.06%, which is a huge difference. The year-to-date return is 0.04%, and the year-to-date risk-adjusted return is 0.02%. The peer ETF that I chose was the Vanguard Total Stock Market ETF. I chose this because I believed it would give a good idea of what the overall index funds compared to the S&P 500 would be. The year-to-date return on my portfolio was 0.04%, while theirs was 0.07%. The risk-adjusted year-to-date percent was 0.02 compared to their 0.06%. Now, I know, looking at the numbers initially, it sounds like the Vanguard ETF is by far the better option to consider. But when you consider the potential underlying advantages, which I'll go into later, of this portfolio that I have crafted, I believe that overall this portfolio is the stronger one. Risk. As far as risk goes, this portfolio does not carry nearly as much risk as the S&P 500. The standard deviation of this portfolio is only 0.010028. Meanwhile, the S&P 500 is carrying a 3-year average of a standard deviation of about 10.53. Notable stock. The stock that's most notable to me that I would recommend to my clients would be Monster. It is performing at a ridiculous level right now. In just the past week, they had a return of 1.29%. And the variance is only 0.000215 with only a standard deviation of 0.014671. As far as the market outlook is concerned right now, I don't believe that this portfolio is in a bad situation at all. The market outlook, because it is a bull market, prices are expected to increase, which is where the potential benefits that I mentioned about my portfolio compared to the Vanguard Stock Market ETF come in play now. Right now, because of prices increasing, that means that these prices are not guaranteed, but most likely to appreciate. And because of the high dividend yields that the stocks in this portfolio already provide, that provides a higher return overall than what would any other mutual fund or individual stocks. So the other good thing about this is, if you've invested in only growth stocks, what happens if the market crashes or it turns into a bear market and then prices start to decline? Then investors start losing money and looking to sell off their assets. But because we are holding a a passive strategy of the buy and hold. We in a bear market, this portfolio will should perform decently still, because we invested in things that should be about their book value or undervalued. However, if the market does go under and these prices never appreciate, that's fine too, because a lot of times when companies are undervalued, they can sell off their assets and then the investor still sees a decent return. In conclusion, while this portfolio initially didn't look like anything compared to other ETFs, I believe it's the portfolio that is sure to outperform the market in the long run. There are so many underlying benefits that this portfolio definitely has the potential to provide, and in some instances the risk is very minimal, if any at all. The main thing that my clients would have to worry about with this portfolio, I would say, is that if prices never appreciate, then they may have some worry. That is where most of the risk would lie. We don't have too many growth stocks invested in this portfolio. So most of it is value stocks, and if the price never appreciated, then that's where most of the risk of this portfolio would come from. But as I stated earlier, there's still benefits that can help out and cut down on the losses some. Thank you.